Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies and their SOFI share price. In this video, we will be going over their latest news updates, and in this article, we will be analyzing the fundamentals of this company. Hopefully, based off of their fundamentals, we can project their future share price, because we want to know what's going on with the company internally, so externally investors can be confident in their investment. After that, we're going to move on and we're going to talk about if Sofi Technologies should be valued as a technology company or as a bank stock, because these entities are valued very differently on the stock market, which could dictate and help us forecast Sofi Technologies' future share price. Lastly, we're going to go over some of the macroeconomic factors that we want to keep an eye out for, because we want to determine if the Federal Reserve is going to ease off on the rising interest rates to get inflation under control. How would this positively impact not only the stock market in general, but Sofi Technologies in particular? So for more news updates on Sofi Technologies, remember to go and smash that like button right now, comment your thoughts down below about where you think this stock is headed, subscribe if you are new, and without further ado, let's jump right into it. Sofi Technologies is essentially a digital bank and a very innovative fintech company which recently surpassed 5.2 million members, which is absolutely phenomenal. And the company defines a member as, I quote, someone who has a lending relationship with us through origination and or servicing, opened a financial services account, linked an external account to our platform, or signed up for our credit score monitoring system, end quote. So all those types of customers would count as a Sofi member. The great thing that we can get from this is that Sofi has a very innovative business model known as a flywheel business model. For instance, let's pretend you just used Sofi to open up a financial services account. Sofi will then give you fantastic offers to do other things with them, such as credit score monitoring services, or linking your external accounts to get direct payment, or maybe getting a lending product from the company. Once you're in their business, they will keep you there through their very innovative ecosystem, and this leads to a higher share price overall. Currently, the Sofi stock price is trading at $6.89 per share, while very bearish negative experts believe this company could fall down to around $5 throughout the year of 2023, or other professionals and experts believe it could surge up to $10 just over the next 6 months. As of late, we've seen the stock price increase pretty dramatically over the last month, to where now the company has hit somewhat of a ceiling and it's slowly trending back down, which is something we should be used to, considering that after very hot catalysts such as their earnings report, we can inevitably expect the share price to cool off a little bit after the hype dies down. Sofi is also doing a great job by attracting even more members than they already currently have, because again, the key to this company is their ability to attract members. This impacts everything for the company regarding not only their revenues, which will scale as membership grows, but also their earnings per share. This is why Sofi Technologies spends loads of money to attract these types of members. For instance, they are offering a 3.75% annual percentage yield without any account fees for their financial accounts, and they will also give you a $250 bonus when someone signs up for direct deposit. And this is pretty phenomenal. For instance, the interest rate of 3.75%, if you put $100 in the account after a year, they will literally pay you $3.75 per $100, and this may not sound like a lot, but compared to other institutions which are giving consumers anywhere from 0.25% all the way to 1%, Sofi Technologies has one of the highest percentage yields. Plus, they're offering you a $250 bonus when you sign up for direct deposit. And it's extremely hard for other fintech companies and banks to compete with this, because Sofi knows that if they can steal market share away from their competition, it sets them up to beat their competition further in the future, especially if they can steal their competition's customers. However, when Sofi offers these great deals to customers, they are also kind of taking a hit, so to speak, because this does increase their overall cost of funding. This is going to negatively negatively impact some financials because they are spending money to attract customers, but SoFi is hoping that the long-term ability for these customers to start to buy other products and services within the company will pay off further in the future. So they're taking a temporary loss so they can use these customers and cross-sell them and upsell them on other products in the future, and that's where they're going to make their overall money, on top of hopefully obtaining a customer who will bank with them forever. And we see this in SoFi's finances. For instance, they took a loss of $43 million on its financial services division in the fourth quarter, and that is because they are offering these fantastic deals to consumers. But we need to put this into perspective because SoFi Technologies management says that this division, referring to their financial services division, will turn profit positive by the end of 2023, which will be extremely impressive for the company, hopefully causing their share price to increase even more at the end of the year. I think SoFi has already demonstrated that their business model is not only interesting, but it works. Their cross-selling and upselling and their flywheel business model works very well. And when we start to talk about their larger segments, such as their lending segment, which brings in the majority of their revenue, that's where things get even more juicy. For instance, instead of SoFi instantly selling loan originations right away, they actually hold these originations on their balance sheet for around 6 months, which allows them to collect monthly interest payments to where essentially it's paying for itself and then some. So they're literally taking money right off of the top for 6 months before they sell this loan to another financial institution, which also makes them money. So they are making money in 2 ways from their lending segment, specifically in regards to their loans. This also prevents the company from putting aside money just in case these particular loans decide to default, which means that if somebody takes out a loan and they can't pay it back, SoFi kind of has to float the bill for that. But that just doesn't happen with SoFi because they only keep it on their balance sheet for 6 months before they sell it. So they are getting interest income from this as well as money from when they sell the actual loan. The only problem with this strategy that I see is that if demand ever falls off for SoFi Technologies loans, this could put them in a very uncomfortable position to where SoFi Technologies would then have to quickly sell these loans for less than the fair value to other banking institutions. But I think that they are hedging their bets quite well, considering that the company is hedging almost all of the loans that are being held on their balance sheet. So clearly they are practicing proper risk management. SoFi also has a very high quality clientele, meaning that their customers have on average a FICO score of around 747. On top of that, their 90-day personal loan delinquency rate, or people who after 90 days can't pay back their loan, was only 0.34%, much better than the majority of every single other bank on the stock market that I can think of. So this is phenomenal news for SoFi Technologies, and even if a recession occurs during the macroeconomic environment, which we will talk about at the end of the video, SoFi is still sitting pretty because their clientele is top tier, so SoFi is not scared of their clients defaulting on any loans even if the economy gets worse. But we'll talk more about the economy later in this video. Right now, let's talk about SoFi Technologies' premium valuation because yes, technically, they are overpriced as of right now, thanks to the surge after the Q4 earnings report, which is why many professionals believe the share price over the next few weeks will decide to cool off, falling well below $7. But despite this cool-off, which is easily predictable, SoFi Technologies' strategy is working very well. But we do need to keep in mind that SoFi is not a profitable company yet, but their management anticipates and projects that the company could achieve profitability by the end of 2023. And if we forecast what the company will actually have to achieve to become profitable by the end of the year, that means the company is anticipated to enter very strong performance phases in the last half of the year to achieve profitability, because as of right now, the shares are trading hands at around 26 times their projected 2023 adjusted EBITDA, which means the shares are rather expensive unless you think of this company more as a technology company than a banking company, which is exactly what we're going to talk about right now. Why is this question important? Well, this question is important because if the market treats this company as a bank stock, banking stocks trade at lower earnings earnings multiples than technology stocks, which trades for higher long-term earnings multiples. So if investors decide that this is a banking stock, the share price is going to go down because it provides them less room for their overall earnings multiple. But if investors value this company as a technology company, then the share price could remain stable and even appreciate in price, which is exactly what investors want. So let's take a closer look at SoFi Technologies to determine which of these two ways of valuing a company investors should look forward to. Like we said in the last article, the forward 2023 adjusted EBITDA would be 26 times, which is exactly what a technology stock would trade at, considering that SoFi Technologies is a newer company to the market, because technology stocks normally trade between 20 to 30 times their overall projected earnings, or just their earnings in general. And this means over the next few years, the company could achieve a $15 price target, which is very good news for investors. However, if investors decide to value this company as a banking company and not a technology company, banking companies normally value stocks at between 10 to 15 times, which means that the share price could hover at around $7.50 from now over the next 3 years, according to their current forecasts. I'm going to quote straight from the article because I like what the author has to say here, and he says, "Nevertheless, SoFi may be able to sustain a tech stock valuation for years to come. Here's how. A majority of SoFi's revenue comes from its lending segment. However, the company's technology platform segment is becoming an increasingly larger part of the business," end quote. So he's saying that because their technology platform segment is growing, and this could eventually bring in a larger slice of revenue, this could positively impact the company and coerce investors to valuing this company as a technology stock and not as a banking stock. For me personally, I would say that SoFi is a mix between a technology company and a financial banking company, because they are literally a fintech company, which combines the two. So I think they should be trading at around 17 times their projected earnings, which means that yes, the share price could pull back some. However, over the next few years, we could see stock price appreciation. And we need to keep in mind that shares are set to cool off over the next few weeks to months, because investors are going to be watching their earnings reports. Their earnings reports will provide either catalysts for this company, sending the share prices higher, or as a negative catalyst, because if this company does not achieve profitability by the end of 2023, we could see the share price absolutely plummet downward. But again, I'd love to hear your thoughts down below on that. Lastly, let's talk about macroeconomic factors, because SoFi Technologies' overall share price could benefit dramatically from new accommodating Federal Reserve policies regarding inflation. Many technology and financial stocks were hit very hard over the last year because as the Fed rose interest rates to get inflation under control, this caused technology and financial stocks to plummet. And it just so happens that SoFi Technologies is both a technology and a financial stock. So let's look at the macroeconomic environment and how the Fed is looking at interest rates to see if we could have another surge in SoFi stock. I want to make you aware first that the Federal Reserve Chairman, who's named Jerome Powell, his comments are very bullish, saying that inflation has improved, to where the PCE index, which is the metric that the Fed uses to measure inflation, declined from 7% in June to 5% in December. And ideally, the Fed wants to keep inflation at around 2%, and that's exactly where it should be in a normal economy. The last time we got good news from Jerome Powell, the SoFi share price jumped from $7 to $8 in the same day. And that was when Jerome Powell remarked that the deflationary process has started, meaning that inflation is going down, which is going to lead to lower interest rates and a better investing environment for technology and financial stocks, which is going to impact SoFi Technologies very lucratively. So I would love to hear your future projections for the SoFi stock price. Subscribe if you are new, smash that like button if you haven't already, don't forget to comment down below, and I will see you in the next YT video.